Every major pension fund in the world allocates to it. The world's wealthiest endowments consider it their most important asset class. It has outperformed public equities by approximately 3 to 4 percentage points annually over the last 3 decades. And the vast majority of retail investors have never owned a single dollar of it. That asset class is private equity. Welcome back to Capital Above Convention. Today, we're cutting through the Wall Street jargon and explaining exactly what private equity is, how it actually works, why it generates superior returns, and how the democratization of access is changing who can participate in it. Let's start with the basics. Private equity is the ownership of companies that are not listed on any public stock exchange. When you buy shares of Apple on the NASDAQ, you are buying public equity. When a private equity firm buys a controlling stake in a mid-sized manufacturing company that has never been listed, that is private equity. The company is privately owned. No public shareholders, no quarterly earnings calls, no analyst coverage, no market price updating every second of every day. Private equity firms raise capital from institutional investors, pension funds, endowments, sovereign wealth funds, family offices, through a structure called a fund. A typical private equity fund has a 10-year life. In the first 3 to 5 years, the fund deploys capital by acquiring companies. In the following 5 to 7 years, the fund improves those companies and ultimately sells them through a public listing, a sale to another company, or a sale to another private equity firm. The proceeds are returned to investors. This is the fundamental cycle of private equity. The firms you have heard of, Blackstone, KKR, Apollo, Carlyle, Bain Capital, TPG, are the largest private equity managers in the world, collectively managing trillions of dollars in assets. But private equity extends far beyond these giants. There are thousands of smaller firms operating in every geography and sector, from mid-market buyout firms in the Midwest to growth equity funds in Southeast Asia. How does private equity actually generate returns? There are 3 primary mechanisms. The first is operational improvement. Private equity firms do not simply buy companies and wait. They install new management, implement operational improvements, cut costs, invest in growth, and fundamentally restructure the business to make it more valuable. A company generating $10 million of earnings when acquired might be generating $25 million of earnings 5 years later, not because the market got more optimistic, but because the business is genuinely better. This operational value creation is the core of what distinguishes private equity from passive investing. The second mechanism is financial engineering, specifically leverage. Most private equity acquisitions use a significant amount of debt to finance the purchase price. This is called a leverage buyout, or LBO. The logic is straightforward. If you can borrow money at 8% and the business you acquire generates returns of 15%, the difference accrues entirely to the equity holders. Leverage amplifies returns, but it also amplifies losses, which is why the operational improvement component is so critical. The third mechanism is multiple expansion. When a private equity firm buys a company, it pays a certain multiple of earnings. When it sells the company, ideally it sells at a higher multiple, so because the company is bigger, more profitable, more defensible, or more strategically valuable. A company bought at 8 times earnings and sold at 12 times earnings has generated a 50% return purely from multiple expansion, before accounting for any earnings growth or leverage effects. These 3 mechanisms, operational improvement, leverage, and multiple expansion, work together to generate the return profile that has made private equity the dominant asset class in institutional portfolios. Over a 25-year period, the top quartile of private equity funds has returned somewhere between 15 and 20% annually net of fees. That is roughly double the long-run return of public equities. Now, the risks, and private equity has real ones. The first risk is illiquidity. When you commit capital to a private equity fund, that capital is locked up for 10 years. You cannot sell your stake on a whim. You cannot exit in a market downturn. This illiquidity is both the source of the illiquidity premium, the excess return you earn for accepting this constraint, and a genuine operational risk for investors who may need capital before the fund reaches its natural conclusion. The second risk is manager selection. Private equity returns are not evenly distributed. The difference between a top quartile fund and a bottom quartile fund in the same vintage year can be 10 percentage points or more of annual return. Unlike public markets, where most active managers underperform the index, in private equity, the best managers genuinely and persistently outperform, but identifying and accessing those managers is extremely difficult. The best funds are consistently oversubscribed and often do not accept new investors. The third risk is leverage risk. The same debt that amplifies returns in a good scenario can destroy a company in a bad one. If a highly leveraged company hits a cyclical downturn, the interest burden can overwhelm cash generation and push the company into distress. Private equity investors who hold a stake in a leveraged company that goes bankrupt lose everything. This is not theoretical. It happens in every economic cycle. The fourth risk is the J curve. In the early years of a private equity fund, returns are typically negative. Capital has been deployed, fees are being charged, and portfolio companies have not yet been improved or sold. This creates a J-shaped return profile over time. Investors who are not prepared for negative early returns, or who need to report positive returns to their own stakeholders, can find the J-curve psychologically difficult even when the underlying investment is fundamentally sound. So how do individual investors access private equity today? The traditional route, committing directly to a private equity fund, requires minimum investments of typically $5 to $25 million and is reserved for large institutional investors and ultra-high net worth individuals with existing relationships with the major firms. This route is effectively closed to most individual investors. The second route is through fund of funds, vehicles that pool capital from multiple investors to build diversified portfolios across multiple private equity funds. Fund of funds lower the minimum investment to somewhere between $1 and $5 million and provide instant diversification. The cost is an additional layer of fees, typically 1% management fee and 10% carried interest on top of the underlying fund fees. The third route is through publicly listed private equity vehicles. Blackstone, KKR, Apollo, and Ares Management are all publicly listed and can be purchased by any investor with a brokerage account. These vehicles provide exposure to the economics of private equity management, including the fee streams and carried interest, but do not provide direct access to the underlying fund returns. The fourth route, and the most significant development for individual investors, is the emergence of evergreen private equity structures and platforms like Moonfare, iCapital, and Titan Bay that provide access to institutional quality private equity funds with minimums starting at $50,000. These platforms have fundamentally changed the accessibility equation for accredited investors who want genuine private equity exposure. Private equity is not a magic box. It is a discipline, a systematic approach to acquiring, improving, and selling businesses over multi-year time horizons. The returns are real, the risks are real, and the access barriers are finally, genuinely coming down. Understanding how this asset class works is the first step to deciding whether it belongs in your portfolio. Subscribe to Capital Above Convention for weekly deep dives into the assets, structures, and strategies that the world's most sophisticated investors use to build and protect wealth. And I'll see you in the next one.